The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is entitled "A Failure to Act: How a Decade Without GSE Reform Has Once Again Put Taxpayers at Risk." I now recognize myself for 4 minutes to give an opening statement. September 6, 2008 is a day that will live on in economic infamy, for today marks the not-so-happy anniversary of one of the most frustrating and costly moments in recent financial history, namely the 10-year anniversary of the federal takeover of the failed housing government-sponsored enterprises Fannie Mae and Freddie Mac. The GSE's anti-competitive government charters and ever-increasing affordable housing mandates created a toxic mess of systemic risk. Their collapse directly led to the second-worst financial crisis in our history, causing more than $190 billion of taxpayer bailouts and forcing them into a government-run conservatorship. Embarrassingly, 10 years later, the GSEs remain in conservatorship, very much alive and very much unreformed, as they quietly return to their pre-crisis market dominance. That's bad news for competition, innovation, and most of all, taxpayers, since the Congressional Budget Office has said their $5.1 trillion of mortgage obligations are, quote, effectively guaranteed by the federal government, unquote. Meanwhile, as several of our witnesses will testify, systemic risk is building yet again. The cost and risk of continuing to do nothing is rising and rising at an alarming rate. Reform, while critical, has proven elusive. For almost 20 years, I, along with the other handful of reformers, like Congressman Ed Royce, have labored in vain to replace the GSE's government-sanctioned monopoly with a new system based on competitive private capital, innovation, consumer choice, and market discipline. We passed the PATH Act in the 113th Congress to do just that. I am reintroducing the PATH Act this week, if for no other reason, it is the right thing to do, and it will let me sleep better at night. Regrettably, its chances for passage remain slim. So as an alternative, I have decided to partner with Mr. Delaney on the other side of the aisle to propose a bipartisan compromise housing reform plan that preserves the government guarantee in the secondary mortgage market. In the time I have remaining in Congress, this is the plan I will pursue. Our discussion draft, which we will unveil later today, will repeal the GSE's charters, permanently ending their monopoly, and transition to a system that allows qualified mortgages backed by an improved private credit enhancer with regulated, diversified capital resources to access the explicit full government securitization guarantee provided by Ginnie Mae. I believe the plan will preserve much of what is demanded in the current system: liquidity, the TBA market, and the 30-year prepayable fixed mortgage. And it will do so while dispersing risk and leveling the playing field for all entrants into mortgage finance. Additional details of our proposal will be released later today. While by no means perfect, we offer this proposal as a grand bargain on how to move past an increasingly dangerous status quo. Codify an explicit government MBS guarantee into law, coupled with an accountable and effective affordability program, in exchange for placing the taxpayer in a catastrophic loss position only, diffusing the credit risk beyond 2 GSEs, and creating market competition. If the political will to enact such reform stalls in this Congress or the next, the administration can and should effectuate change. The President will appoint a new Federal Housing Finance Agency director in January. The director has broad, unilateral powers as conservator of Fannie and Freddie to dramatically reduce their size, scope, and functions. If Congress fails to act by early next year, I call upon the new director to institute these reforms administratively. The grand bargain I have described does not necessarily represent my preferred policy or optimal policy, but I believe it represents an achievable policy and a good faith effort at bipartisan compromise. A decade without GSE reform has once again put homeowners, taxpayers, and the economy at risk. The time to act is now. With apologies to the Rolling Stones, you can't always get what you want, but if you try sometime, you just might find you get what you need to avert the next housing crisis. I now call upon the ranking member. I yield her 3 minutes for an opening statement.
Thank you, Mr. Chairman. Mr. Chairman, this hearing will focus on the failure to reform our housing finance system. I would point out that Republicans control the House, the Senate, and the White House, and there have been no apparent steps to advance comprehensive housing finance reform since they gained that control. It was over 5 years ago that committee Republicans pushed the PATH Act through this committee. That bill was not seen as credible. It failed to gain unanimous Republican support in committee, and the Republican leadership of the House declined to bring the bill to the House floor for a vote. I am in support of responsible efforts to reform our housing finance system. I believe we must evaluate what Fannie Mae and Freddie Mac have done well as areas where the system still needs improvement and reform. Contrary to the claims of the majority, Fannie and Freddie did not cause the crisis. The final Financial Crisis Inquiry Commission and others have made that clear. As we all know, the crisis was driven by predatory lending, the private market packaging those toxic, risky loans into securities and then selling those securities to unsuspecting investors. Fannie and Freddie did not drive those actions, but the events that transpired during the crisis made clear the need for their reform. While the Republican-controlled Congress has yet to act, the Federal Housing Finance Agency has taken significant administrative steps to improve the safety and soundness of the enterprises and reduce risk to taxpayers. As we consider housing finance reform and work to address the structure of our housing finance system, it is a priority for me to ensure that underserved borrowers and communities are not overlooked. This means that at the heart of any reform proposal, we need a comprehensive strategy around access to affordable mortgage credit as well as access to affordable rental housing. And with that, I yield back the balance of my time, Mr. Chairman.
Gentlelady yields back. I now recognize the gentleman from Wisconsin, Mr. Duffy, chairman of our Housing and Insurance Subcommittee, for 1 minute.
Thank you, Mr. Chairman. 10 years. 10 years on since the financial crisis that was caused by a mortgage crisis that put the U.S. economy and the global economy into a tailspin. And at the center of that crisis was Fannie Mae and Freddie Mac. That was allowed by way of a government guarantee to create a risky book of business they should have never been able to take. And so what did the Congress do? We passed Dodd-Frank. And I don't want to get into a spitting match because I'll say Dodd-Frank didn't do the reform that was necessary in the housing space. And the ranking member will say, well, you guys have controlled Congress, and now you have the White House. What have you done? And I think that's fair enough. The point is that we have to come together as a Congress in a bipartisan fashion and figure out a way to address our housing finance system and make sure it works. But now to look 10 years on that Fannie and Freddie are in conservatorship and they have become bigger beasts than they were even before is troubling. This is, just 1 second, Mr. Chairman. Housing is important to America. Housing is important to families. You can't have a partisan bill, and that's why I'm proud of Mr. Delaney and Mr. Hensling for working together. Whether this is the package that we move forward with or a different package, we have to come together as a Congress representing American families to make housing work in a more sustainable way. I yield back, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes gentleman from Michigan, Mr. Kildee, vice ranking member of the committee, for 1 minute.
Thank you. Excuse me. Thank you, Mr. Chairman and ranking member. We've talked about GSE reform for a long time in this committee. Several bipartisan proposals have been offered, yet we've been unable to move any of those bipartisan bills to the floor. I hope that changes. I have some reason for optimism, but I hope it does happen. It's also important not just that we talk about this and raise it in this meeting, but we do so with facts and data rather than bias and misdirection. We have to be wary of those who try to blame the 2008 crisis on expanded home ownership opportunities for low and moderate income people. We need an honest assessment of the larger role that other factors played, including the market for mortgage-backed securities, deregulation, the availability of risky, non-traditional lending products. Home ownership opportunities have to be available for low and moderate income families, something that bipartisan GSE reform can encourage. So it's up to this committee to ensure that reform doesn't pit investors and lenders against one another to the detriment of homeowners. Finally, GSE reform must include a government backstop for the secondary market. Without that, we could see the end of the 30-year fixed-rate mortgage, which is the product around which our markets are calibrated. I look forward to working on this issue, and I'm encouraged by what I hear in the last few days. I hope we can move something this year. We shouldn't give up on that possibility. This is really important. I thank the chair and the ranking member for holding this hearing. I yield back.
Gentleman yields back. Today we welcome the testimony of Mr. Ed DeMarco, President of the Housing Policy Council. Mr. DeMarco earned a BA in economics from the University of Notre Dame, a PhD in economics from the University of Maryland. Prior to joining the Housing Policy Council, Mr. DeMarco was a senior fellow at the Milken Institute and was the acting director, as I think we all know, of the FHFA for 4.5 years. Dr. Philip Schwagel is the professor at the University of Maryland School of Public Policy. Dr. Schwagel earned his BS from Princeton University and a PhD in economics from Harvard University. Prior to joining the University of Maryland, Dr. Schwagel was a visiting professor at Georgetown University and the assistant secretary for economic policy at the Treasury Department. Next, Ms. Nikitra Bailey is the executive vice president at the Center for Responsible Lending. She earned a BA from the Pennsylvania State University and a JD from the University of Pittsburgh School of Law. Prior to joining the Center for Responsible Lending, Ms. Bailey was a communications fellow for the Opportunity Agenda. Last but not least, Mr. Ed Pinto is the co-director at the Center on Housing Markets and Finance and resident fellow at the American Enterprise Institute. Mr. Pinto earned a BA from the University of Illinois and a JD from the Indiana University School of Law. Prior to joining AEI, Mr. Pinto was Vice President and Chief Credit Officer for Fannie Mae. I think most of you have testified before, so each one of you, I believe, knows you will be recognized for 5 minutes to give an oral presentation of your testimony. When the yellow light comes on, you have a minute remaining. Without objection, each of your written statements will be made part of the record. Mr. DeMarco, you are now recognized for your testimony.
Thank you, Mr. Chairman. Mr. Chairman, Ranking Member Waters, members of the committee, thank you for having me here today. It's an honor to be back before you, this time in my capacity as the President of the Housing Policy Council. My prepared statement makes the following key points. Fannie Mae and Freddie Mac failed 10 years ago and were placed into government conservatorships backed by billions of taxpayer dollars. The reason for this conservatorship and for this massive amount of taxpayer support is that if their failure had led to shutting them down, the systemic ramifications of that would have been devastating. It was said at the time, and I detail this in my statement, and since, that the final resolution of these conservatorships requires congressional action. Why is that? Simply put, it was the Congress of the United States that created these companies, chartered them, gave them their mission, gave them their special privileges, gave them their names, and reserved for itself, reserved for Congress alone, the authority to change the charters, eliminate the charters, create new charters, merge the charters, and so on. So that is why, with these companies in conservatorship, we are awaiting congressional action. Now, in the 10 years since, a lot of positive developments have taken place, including developments that give the Congress something to build on. This includes the development of a credit risk transfer market, common securitization platform, and in those ways, things have gotten better, but in some ways, things have not. Indeed, the systemic reliance we are placing on Fannie Mae and Freddie Mac, if anything, has grown in these 10 years. So 10 years ago, we saw all around us the manifestations of systemic risk in our financial system. And since then, the Congress and regulators and indeed private financial firms have taken many steps to address these systemic issues, but the ones embedded in our housing finance system are still unchecked. So on behalf of the Housing Policy Council, I'm here to say we need Congress to make the policy decisions only elected officials can make. The good news for all of you is that there is a foundation to build upon. I already mentioned the work being done by the conservator, but there's more than that. Just in this committee, there have been 3 comprehensive proposals, one by the chairman, one by the ranking member, one by Congressman Delaney and Himes. And just now, we've learned of a bipartisan approach that creates a 4th basis upon which to work. And that's not all the good news. There's also this. As I review in my written statement, there's broad agreement on many of the basic principles and desired outcomes we're trying to achieve. So the Housing Policy Council welcomes the chairman's latest proposal with Mr. Delaney and looks forward to reviewing it and working with this committee, not just for the remainder of this year, but until the job gets done. In the meantime, we hope the FHFA and the Treasury continue to support Congress by carefully examining the common elements across reform proposals and taking the administrative steps consistent with these proposals that will make legislating easier and the transition easier. I'd like to make a final comment. It's easy to focus all this discussion on what to do with Fannie Mae and Freddie Mac, especially today as we mark this 10-year anniversary. But we should not let the discussion get wrapped up in focusing just on Fannie and Freddie. Our goal is to strengthen and modernize a credit market, a market essential to one of our fundamental needs, the need for housing. Our focus should be on the market, in this case, the secondary mortgage market, and how it connects the ultimate borrower, a person or a family looking to buy a home, with the ultimate provider of those resources, the investor. So let's start by remembering the key principles of a sound market system: competition, transparency, consistency, data, equitable rules, and so on. And let's remember that with financial markets, systemic risk is a real threat. We ought to disperse risk through the system, not concentrate it. And we ought to avoid deep concentration of market power in the hands of 1 or 2 firms. And finally, let's remember sometimes social goals can only be met with the help and support of government. Right? In housing finance, one key element of that support comes from the FHA program and other government insurance programs. They also need to be part of our conversation if we want to envision a complete, safe, and sound housing system that assures the opportunity of sustainable home ownership. So, Mr. Chairman, thank you for inviting me to this hearing, and I look forward to participating in the discussion.
Dr. Swagel, you are now recognized for your testimony.
Thank you. Chairman Hensarling, Ranking Member Waters, members of the committee, thank you for the opportunity to testify on the subject of GSE reform. I was at the Treasury Department 10 years ago when Fannie Mae and Freddie Mac were taken into conservatorship. In fact, I testified in this room before this committee 10 years ago next week on housing policy, the same day that AIG was rescued, bailed out. I think no one envisioned that 10 years later, the 2 firms would remain in government control and that taxpayers would still be on the hook for so much credit risk. Reform is still needed. Too many families still find it difficult to get a mortgage, while the dominant government loan, the dominant government role means that taxpayers are taking on too much risk. Today's housing finance system should be unsatisfactory to all sides. With the 2 firms at the time, and still the linchpins of the U.S. mortgage system, allowing them to have failed 10 years ago would have risked systemic consequences. 10 years later, however, the 2 firms are still undercapitalized and still too important to be allowed to fail. That's the key problem. Housing finance reform should clarify the roles of the private sector and the government. If the 2 firms or any other firms competing in housing finance are still too important to fail, simply stating that there will be another bailout, simply stating that there will not be another bailout is not credible. A return to a duopoly of private firms, such as with the recap and release idea, would reconstitute the implicit guarantee that was the most problematic aspect of the pre-crisis system. At the same time, considerable progress has been made in conservatorship. And I think it's important to recognize that FHFA, under the leadership first of Ed DeMarco, and then most recently under Director Mel Watt, deserves credit for this progress, as do the two firms themselves. Most importantly, there is now private capital taking on housing credit risk ahead of taxpayers. This is important progress. Reform, though, should go further to improve incentives and better protect taxpayers. As policymakers, you should look skeptically at the suggestion that requiring adequate capital will price people out of mortgages. If a certain amount of private capital is enough to protect taxpayers against all but catastrophic risk, then additional capital should not be at risk. It cannot be the case that taxpayers are safe and yet more capital has a large impact on interest rates. If capital is expensive, well, then taxpayers are not safe. It can't be one or the other. Administrative measures, while legislation is still being discussed, should focus the GSE activities, especially on improving their effectiveness. My written testimony discusses several suggestions. I want to briefly focus here on ways to improve the effectiveness with which the housing finance system supports affordable housing. The current system provides about $3.8 billion every year in cross-subsidies within the pricing structure of the insurance premiums charged by Fannie and Freddie. Essentially, lower-risk borrowers pay more, so that higher-risk borrowers get a subsidy. The problem is that nearly 1 in 4 of the borrowers who receive a subsidy in the current system are not low-income and not moderate income. Right? The subsidies are not allocated based on need. The impact is that a lower-income family that has prudently accumulated a down payment and has lived within their means ends up paying more to subsidize a wealthier family with a small down payment and lots of debt. Right? We can focus the affordable housing assistance, even the amount that's there today, and provide much better and more effective assistance for the families who need help. Housing finance reform remains necessary 10 years after Fannie and Freddie were taken into conservatorship. Not moving forward leaves too many families still facing difficulty obtaining mortgages and taxpayers taking on too much risk. Reform can improve the safety of the housing finance system and better protect taxpayers, and also provide for more access for mortgage financing and better support for affordable housing. Thank you very much.
Ms. Bailey, you're now recognized for your testimony.
Good morning, Chairman Henserling, Ranking Member Waters, and committee members. I thank you for the opportunity to testify on this critical issue of GSE reform. 10 years after the housing crash of 2008, millions of hardworking families most harmed by unnecessary foreclosure continue to be locked outside of the nation's steady recovery and housing finance system. However, their hopes to participate in the American dream of homeownership remain strong. I am Executive Vice President of the Center for Responsible Lending, a nonpartisan research and policy organization dedicated to protecting family wealth and ending predatory lending. We are affiliated with one of the nation's largest community economic development credit unions, Self-Help, which is based in Durham, North Carolina, and has provided over $7 billion of safe and responsible credit in communities all across the country. The Bipartisan Housing and Economic Recovery Act of 2008, enacted by Congress, represented substantial reforms to the nation's housing finance system. This act put in place a new and empowered regulator. Moreover, the Dodd-Frank's ability to repay standard and qualified mortgage rules together provided baseline mortgage protections that have enabled the steady, though uneven, recovery we experience today. The sum of these reforms returned profitability to the nation's financial institutions and is well documented in regulatory reports. Earlier this month, the Federal Deposit Insurance Corporation reported that the U.S. banking sector reported a record $60 billion in profits in the second quarter. With these gains now, it's time for the GSEs to be restructured. It is a needed action that can be taken administratively. Among housing stakeholders, there is broad consensus that the housing finance system needs an explicit and fully paid for government guarantee with private capital in a first loss position. However, we equally acknowledge and need to resolve this fundamental disagreement with any proposal that calls on the elimination of the enterprise's chartered duty to serve obligations. The duty to serve provisions that begin in the charters and remain in HERA require that credit is available in all markets at all times. This directive creates liquidity in every community, including rural ones, and for community banks and for credit unions. These requirements ensure that lower wealth borrowers get an opportunity to succeed in homeownership. They also provide mechanisms to keep smaller banks on equal footing with private banks. Any reform that the system builds that moves us towards excessive risk-based pricing has to be opposed. Average pricing actually makes mortgage loans more affordable. Our nation's fair lending laws, along with HERA and Dodd-Frank, underscore a long-standing federal commitment for safe and responsible mortgage credit on affordable terms. These principles also evidence a belief that the system should not only serve borrowers with the most pristine credit profiles. Congress has exercised extreme caution thus far. You must also reject untested models that introduce anxiety that come with higher cost projections and provide less access and affordability for working families. Today, we mark the 50th anniversary of the Federal Fair Housing Act. So as we think about GSE reform and all that it offers, we have to deal with the fact that 50 years later, Black Americans still have the same rates of homeownership that they had in 1968 when this Congress passed that significant legislation. We also have to look right at the federal government's role in fostering historic discrimination that has put us in the racial wealth gap that we are dealing with today. Today, African Americans have 13 times the wealth of whites. Latinos have 10 times less the wealth of whites. That is the result of federal housing policy that said we will only insure mortgage loans to white families for a significant portion of those programs starting. They have given whites a heads up and have denied African Americans and Latinos an opportunity for equal parity. Discriminatory redlining, along with predatory mortgage lending targeted at families of color, placed them at higher risk of foreclosure. Many families were steered into loans with dangerous features and higher costs, even when they qualified for loans on safer terms that were cheaper. CRL's research shows that for people who did not even experience foreclosure, they lost $1 trillion of wealth in communities of color. So they didn't have a foreclosure themselves, but they lived in a community where there was a propensity towards it. So the federal government role needs to be addressed, and now is the time to do it. Thank you for this opportunity. I appreciate it, and I look forward to answering your questions.
Okay, Mr. Pinto, you are now recognized for your testimony.
Thank you, Chairman Hensling and Ranking Member Waters, for the opportunity to testify today. In all the work that I do, my prime interest is in the big picture policy implications informed by data about housing finance. I'm also interested in pointing out the various ways that the housing lobby distorts national policy discussions for their own benefit and the detriment of first-time buyers and taxpayers. In my written testimony, you will see a lot of detail, but my remarks are going to focus on big picture policy implications. I'll be referring to some of the numbered charts in my written testimony. My testimony is based on risk rating of 60 million individual mortgage loans dating back to 1990 and price appreciation trends for the most recent 9 million. I'll cover 4 points that are informed by our research: house price boom 1.0 from the 90s and the aught years, the current house price boom 2.0, both driven by government policy. These same policy decisions are promoting leverage and leave entry-level buyers and taxpayers more exposed. The long-running conservatorship and how that's been used to strengthen the GSE's taxpayer-backed duopsony, and prompt administrative action is advisable now. The figure 1 shows that the risk buildup that took place starting in the early 90s and ending the first time in 2007 at the GSEs coincided with real house price increases over the same period. This buildup is starting up again since 2012, and as are house prices, which are in a boom 2.0. The FHA is a big part of this process. For many decades, U.S. housing policy has relied almost exclusively on increasing borrower leverage in a failed attempt to make housing more affordable. This is because credit easing in a seller's market makes homes less affordable as the easing gets capitalized into higher prices. Figure 2 shows that the history of GSE debt-to-income ratios over the past 30 years confirms this. Sellers' markets coincided in both times with the rapid rises in DTIs and the real house prices that occurred during boom 1.0 and 2.0. Turning now to some of the deleterious actions of Fannie Mae, Freddie Mac, and the Federal Home Housing Finance Agency since the beginning of the conservatorship. The DTI patch was announced by the Bureau for Consumer Financial Protection in 2013 and is still in effect and bears special mention. Since 2013, 85% of all primary home purchase financing has been guaranteed by agencies eligible under the patch. Figure 3 shows that rather undertaking an orderly transition period to the qualified mortgages 43% DTI limitation. This was what was envisioned by the Bureau. The FHFA, the GSEs and FHA and the VA all took advantage of the patch to promote higher DTI loans. Private portfolio lenders and RHS showed much less use of DTIs greater than 43%. As a result, 36% of agency guaranteed loans that originated in March 2018 had a DTI in excess of 43%, the QM limit, double the level the month before the patch was announced. It may shock you to learn that 26% of FHA's purchase loans have a DTI greater than 50%. I'll now turn to the core of the problem. In my view, not enough attention has been paid to the policy arena, to changes in leverage or to the distinction between buyers and sellers markets. We are introducing 4 new price indices to help highlight these changes. One of the innovations is that we divided the house prices into 4 bins because the market behaves differently for each bin. Our broad conclusion is there's a strong correlation between increasing census-tracked home price appreciation and increasing census-tracked mortgage risk index. As you can see from Figure 7, most first-time buyers are in the bottom of the 2 bins, and their mortgage loans are much riskier. Prices in the low bins have increased much faster, 41%, than medium-high and high bins at 28%. This aggressive financing has been a key driver of excessive house price appreciation. In the low bin, 80% of the loans are guaranteed by the GSEs and FHA. There's no doubt where this impetus for higher prices is coming from. Consider if low prices had increased at the same rate over the medium as the medium and high tier, medium, high, and high tier price bins. Entry-level buyers today would be able to buy the exact same home for an average of $17,000 less and with a lower risk of default. This is a badly designed housing policy that's in place. In my written testimony, I list a number of areas where the long-running conservatorship has been used to strengthen the GSEs. I'll leave that to your review. What about solutions? Let me start off by saying measured step nows would moderate the current pace of unsustainable home price increases. In terms of legislation, I believe the PATH Act is the only viable solution. In terms of administrative steps, prompt action should be taken by 4 agencies: HUD, Bureau of Consumer Financial Protection, and FHFA and Treasury. These are all laid out in my written testimony. Thank you.
Thank the witnesses for their testimony. I yield myself 5 minutes for questions. Mr. DeMarco, I was struck by your written testimony. On page 3, you subtitle that portion of your testimony, "Yet systemic risk is growing, not fading." You mentioned that there are signs that underwriting standards are weakening, that pricing by the GSEs is less than that backed by private capital. You talk about the government's involvement growing substantially in the 10 years since the conservatorship. And then I am really struck by your quote, "The level of systemic risk posed by the GSEs has grown over these 10 years," unquote. Is one of the 4, as somebody who spent 4.5 years of their life as the GSE's regulators and probably one of the 3 or 4 most knowledgeable people in the galaxy about the GSEs, this is a profound statement. Can you elaborate?
Thank you, Mr. Chairman. Yes. What I'm trying to indicate here is that during this time of conservatorship, while we provided taxpayer support to the conservatorships to keep Fannie Mae and Freddie Mac functioning so that the country would have a functioning secondary mortgage market, given the duration of these conservatorships and the path that we have since followed, what we have effectively done is concentrated more and more of the actual decisioning and credit risk management and risk assessment and pricing in these two companies operating in a government conservatorship. So end to end, Fannie Mae and Freddie Mac are responsible for virtually all the risk, for a great deal, if not virtually all, of the risk analysis, pricing, and risk bearing in our housing finance system, particularly, certainly for the $5 trillion of it that they are directly involved. They determine which counterparties can participate in the system and in what manner. They have broad reach to all stakeholders whose functions are actually intended to manage and mitigate risk, whether that be a mortgage insurer, or a title insurer, an appraiser, or a lender. Right? So they set the rules of the business for the entire market, including the underwriting box and, as I said, the pricing and so forth. So this tremendous concentration of being responsible for the decisioning, the decisions and the practices governing credit risk in our mortgage market is, to me, building systemic risk.
Thank you. Mr. Pinto, you say something similar in your testimony where you speak of we are in the midst, quote, we are in the midst of another potentially dangerous buildup of housing risk. Now, you have, I guess, a proprietary system, mortgage risk index. You say it is on the rise again. How is this comparable to the buildup of risk that you saw before the 2007-2008 real estate bust?
Thank you, Mr. Chairman. We are seeing risk increasing. We risk rate every loan that the agencies guarantee each and every month. We've been tracking this for 5 years. It's a little difficult. We haven't completed our research to compare it completely back to what it was last time, particularly for FHA, which is a big part of the risk. What we focus on is how the risk is going up generally, and then how that ties into house price increase. And the research that I presented today shows very clearly that the higher the risk in a census tract and the percentage of loans that are high risk in a census tract, the faster the house prices go up. And this is because these policies that the federal government has done nothing to add any supply. It only promotes demand, and demand in a pernicious way. You can afford to buy a more expensive house even though it's the same house that sold for 10% less a year ago. And that's what we're seeing. House prices going up year after year for the same houses in entry-level markets, and the government is providing the leverage that allows that to be purchased.
You also said in your testimony almost half of the GSE's 2017 volume wasn't even related to buying a primary residence. Another 41% went to help well-to-do buyers. And only 3.7% of GSE dollars went to repeat buyers of more modest homes. So can you elaborate again how the GSEs are making entry-level homes less affordable?
So again, a very little amount of the GSE's business goes to entry level, but because the GSEs are so huge, they are 50% of all the mortgages. So even if, say, 10% of their business is going to entry level, but at very risky terms, then that is cascading through these markets along with FHA loans in these low entry-level price points, and that's what's driving up the price. What we find is that today the GSEs, particularly Fannie Mae, are increasing their risk most rapidly in the entry level, and that's because they're in competition with FHA.
Thank you, Mr. Pinto. My time has expired. I now recognize the ranking member for 5 minutes.
Thank you very much. Before I get to a question about this discussion about systemic risk, I'd like to ask Mr. DeMarco, what good has happened since conservatorship, and how has it been managed, and what good can you say about it?
I can say a number of good things as I went through in my prepared statement. First of all, conservatorship actually did ensure stability of our secondary mortgage market during the financial crisis. Second, while we had challenges in getting this, trying different things and seeing what worked and didn't, the conservatorships did a lot to help prevent foreclosures and to help people stay in their homes. A lot of effort was poured into efforts to bring stability to existing homeowners. Third, we've built a number of foundational, or we are in the process, the FHFA continues to build foundational cornerstones for reform, including credit risk transfer work that's been done, the common securitization platform, loan level data disclosures that have begun, and so on.
Very good. Now, what evidence do you have of this systemic risk that you're trying to describe to us today that you blame the conservatorship for?
So because in conservatorship, these companies continue to operate with the tremendous advantages that they had before conservatorship, now added with the added benefit of the government backing. These companies are the ones that are responsible for determining everything about credit.
I understand that, if I may interrupt you. I understand what you have described, but what's the evidence? Where do we see the risk? Where is it actually manifest? Where is it demonstrated?
Well, I think a couple of my panelists, fellow panelists, have provided a good bit of data on that point, but I would point to a few things. The decisions to relax underwriting standards in certain places is in the province just of Fannie and Freddie. So, for example, they get to determine who gets an appraisal waiver when they buy a home. In terms of rules that this Congress, the Congress established through Dodd-Frank on a qualified mortgage, really trying to get the Consumer Financial Protection Bureau to set standards of what constituted a qualified mortgage, we've written this huge loophole for Fannie and Freddie that says, well, while this rule, this QM rule is really important, it doesn't apply for Fannie and Freddie.
Okay, I appreciate that. And if the rule does not apply on qualified mortgages, then you're saying great risk is being created. You think it can be, but you have no demonstration that it has created risk. I'm going to move on to Ms. Bailey. What do we need to expand housing opportunities for the average citizen and for low income?
Yes, thank you so much. Fannie and Freddie, along with FHA, actually did what they were designed to do. They actually sustained the market when private credit withdrew. Risky private credit led us to the crisis, and that's evidenced in the Financial Crisis Inquiry Commission on page 26 and 27. So they did exactly what they were intended to do. FHA actually increased lending at that time when Fannie and Freddie were in trouble, and actually has now returned to more stable base levels. So, Mr. DeMarco, while I appreciate the wonderful perspective he's offering today, he instituted policies in his tenureship of loan level price adjustments when he was the director of the Federal Housing Finance Agency. That agency's decision actually made it more expensive for people of color and lower wealth families to afford loans guaranteed by the GSEs. So I would like to get a better understanding about that decision and knowing how that was going to have the outcome that we're talking about today, where we're saying that the GSEs aren't serving the broader base market. That decision happened during that. Today, we need to make access and affordability central in this debate, and we need to get at price and segmentation. The whole system today is moving towards segmenting borrowers by credit buckets, and by doing that, we're getting rid of something that has sustained the system for a long time, which is average pricing, which allows us to make sure we have affordable mortgages across the nation.
What would you advise us to do to ensure that we could include more low income and more minorities in these housing opportunities?
Continue the system back towards pooling of loan risk, because when you segment by the credit buckets, pricing actually determines who can actually afford a mortgage, and that's where most of the proposals are off track.
Thank you very much, and I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of our Housing and Insurance Subcommittee. 5 minutes.
Thank you, Mr. Chairman. Ms. Bailey, I just want to clarify, I think, something that you said in your opening statement. Are you saying that we should get rid of risk-based pricing in the mortgage market?
No, sir. I'm saying we should get rid of excessive risk-based pricing. The mortgage market already has risk-based pricing built in. But what we've done now is to say we're going to go in and put the burden of risk on borrowers that the Financial Crisis Inquiry Commission said did not actually cause the crisis, lower wealth families.
Okay,
so what we're saying to those families who also have a history of racial discrimination that resulted in them having lower credit scores and smaller down payments, that they actually have to pay more now in this current system when they were not responsible for the housing crash. Right. So what I'm saying is continue to do what the system does well. For many, many years, the system has provided broad liquidity in every community across the nation. Both GSEs, Fannie Mae and Freddie Mac, have made sure we could expand credit across the nation. So continue to do what they actually do really well, and don't get rid of such a foundational aspect of the system so that we can bring in the very borrowers that the future system depends. 7 out of 10 future borrowers are going to be people of color. So we talk about affordability, but we've got to think about it in terms of
I want to be clear. So as long as our system is blind to race and religion and sex or sexual preference, blind to those things, you're okay with us looking at someone's risk profile in regard to pricing of a mortgage?
I appreciate you thinking that the system is blind to race
and
sexual orientation, but it's not, sir. The housing finance system is really rooted in a history and a legacy of intentional.
So I guess I'm saying, so should we say, are we going to base prices then on race and sex and sexual preference?
Say that again, sir.
Are we going to base our prices on race or sex or sexual preference or religion? Is that what we should do?
Part of what we're doing is we're saying that we know that the impact of these practices impact people of color, women, and lower wealth families differently, and we're still orchestrating policies towards those.
I'm going to reclaim my time. Mr. DeMarco, what happens in a system where we don't base pricing on risk? Obviously, we all want to make sure that a system is blind to race and sex and religion and based on credit, but that's the way the market should work, right?
Right. I mean, certainly when one is talking about insurance, if you don't price based upon risk, you get more risk.
Mr. Pinto?
I agree. If you don't price on risk, you get more risk. FHA is a perfect example of that. It does not price on risk, and it gets a tremendous amount of risk, and it's at the foundation, along with the GSEs, of this house price boom.
And when you have more risk, that can lead to crises, which help the poorest among us. Fair enough?
Fair enough.
Okay. Mr. DeMarco, you talked about what might not appear to be obvious to the average eye, but the bills that you've looked at that have come out from both sides, there's a lot of common themes. I don't have a whole lot of time, but want to touch on a few common themes that you see everyone in the Congress talking about, where we could wrap our hands around a pathway forward that everyone could buy into.
Right. I'll do two to be brief. The first is that Fannie Mae and Freddie Mac do not continue forward as government-sponsored enterprises. That doesn't mean that they get liquidated. It means that their specialness and their privileges and protections go away, and whatever they are transformed into, they have to compete in the marketplace on the same footing as everyone else. So we can keep the functions that they have been providing in the market, but make those functions available to be provided by others. The second thing is that there now, with the chairman's announcement today, there certainly seems to be broad consensus about establishing a single mortgage-backed security that has a catastrophic guarantee from the taxpayer, but is backed by substantial private capital in a first loss position. And that's true from the chairman's proposal to Mrs. Waters' proposal and all the others.
I think one of the great debates we'll have to have is, where does that catastrophic guarantee kick in? We don't want it too low, where the market would assess that obviously it's too low, and the Congress is going to step in and save the market before the legislation would kick in. Fair enough?
That's correct.
Okay, just want to quickly ask the panel about any concerns about FHFA and transparency today. Mr. Pinto, any concern there?
Which?
Transparency. Can we encourage more transparency in the markets today?
I think there should be more information released about the mortgages that are being made. There should be complete transparency, and that should come from all the agencies, and it should go back in time in terms of those loans, so those can be looked at and researched.
Mr. DeMarco?
Yes, one of the things that could be done is to further make available to the public the loan level details of the loan portfolios of Fannie and Freddie.
Thank you. I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Thank you, Mr. DeMarco, for sitting down with me some time back and discussing some of these issues. Mr. Duffy and I have had a number of conversations, and he just talked about one of the things that I lift up as something that must be involved in any kind of reform of the GSEs from my standpoint, and they are, as I've said before, the 30-year fixed mortgage rate, as well as the explicit government backstop. I would like for the entire panel to tell me something that you believe to be inextricable to a reform package of the GSEs, other than the two that I've just laid out. Anyone?
Well, go ahead.
I would say these systems' current affordability provisions, its duty to serve, the ability to provide broad liquidity in every credit market across the nation, and the housing goals, they're really important to ensuring that we have an inclusive and broadly serving mortgage market. So those would be additional ones, along with ensuring that small lenders remain on equal footing with their larger bank competitors.
What specifically can we do to increase affordable financing or financing of affordable housing? What can we build into the infrastructure of a reform package for the GSEs that would assure increased funding for affordable housing, which is one of the biggest needs in the country right now?
Right.
Yes, sir, I totally agree with you, and I would say that the move towards excessive risk-based pricing is really making it really challenging. So underwriting standards help determine who should qualify for a mortgage. Pricing actually determines who can actually afford to pay. And when we move towards these excessive standards, we make it too expensive for working families to afford these mortgages. So what we often see is that FHA is now over-concentrated with a segment of borrowers, upper-income people of color, Latinos and African Americans, that the conventional market should be serving, but because of the historic discrimination and lower down payments and lower credit scoring, that's the result of the historic discrimination, they are not able to get conventional markets from the conventional space.
Mr. DeMarco?
Yeah, Mr. Cleaver, to your first question, the thing I would add that is fundamental to reform is providing real clarity about what is the role of the government in our housing finance system and where and how is that role manifested. And then what is, on the other side of that coin, what is the role we expect of the private market to bear, and is that private market allowed to actually operate as a market and given the tools and the guardrails necessary? So that clarity would help a lot.
Thank you. Thank both of you for that. We're in receivership. What is missing now? What's going awry? I mean, let's just assume we do nothing. What would be the consequences of us doing nothing right now, leaving GSEs in a conservatorship?
Well, all of the credit risk that is being run through those companies is being supported by the American taxpayer.
I think it's important to also add, though, that they are offloading some of that risk with the credit risk transfers. So they are, and I think all of our testimonies acknowledge that they are actually offloading some of that risk to the private market. The question is, are they offloading it in a way that gets rid of that segmentation of pricing that we talked about earlier? We see that some of that is happening on the front end, and it's safer when it happens on the back end. So we just need to move the system more towards that back ending when we're doing credit risk transfers. But they are offloading some of the risk on the private market. The key is to make sure private capital comes in a safe and responsible way. The only time when private capital dominated the market, we ended up in a national housing crash. So we want to just be careful with private capital. I think we all agree that it needs to come back in, but we've got to do it in a way that's really safe for borrowers as well.
If I just add quickly, You know, we're going to miss out on innovation if we stay with the current system, and we won't know what we're missing out. We know that too many people still can't get mortgages, and that's because the dominant government role has pushed away private innovation, and that's what we'll miss with the current system.
Thank you, Mr. Chairman.
Time of the gentleman has expired. Chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of our Capital Markets Subcommittee.
Thank you, Mr. Chairman, and I've got about a half an hour's worth of questions. We're going to try and do this real quickly. And one of the things I want to start with, and I'd like to move right down the panel, and if you could quickly answer these two things. What do you think the proper loan-to-value would be for the GSEs to be involved and engaged? And also, what's the proper debt-to-income ratio for borrowers? What should that be? So, Mr. DeMarco, and I'll just move right down.
Mr. Huizinga, those are challenging questions because households don't.
That's why I'm asking the experts.
No, but I think it's risky to give a single answer to a question like that, because if I told you that the proper debt-to-income ratio was 38%, I mean, how does that work for a retiree who has retained a lot of assets but doesn't have income and wants to buy a retirement home? So that's an example of why a single answer is challenging here.
You know,
well, I'm sorry, but how about for the GSEs to be involved, though? I mean, I understand that debt-to-income ratio maybe for individuals, but what should that loan-to-value be for a GSE's involvement?
Well, when I was the acting director, we had it at 95% was the maximum. It's currently 97.
Mr. Schweigel?
Yeah, I'll just add. Obviously, I agree with Ed. If we're going to have the government behind these risky loans, let's acknowledge it and make that explicit, and not bury it within the details of the GSE pricing system. If we take on risk, let's account for it.
So no percentage.
I apologize. I also, again, like Ed, I don't have a particular number because the circumstances of borrowers will vary so widely.
But again, if we're looking at risk in the GSEs, what should that level of risk be?
I would agree with Ed. I wouldn't want the sorts of 3.5% loans that the GSEs have been instructed to push. That to me seems...
Would returning to the 95% that Mr. DeMarco had just referenced, would that be acceptable, better?
You know, 5% down payment, it just seems a very modest amount. We know housing prices can go down as well as up. I think that puts borrowers at risk.
Okay. Ms. Bailey?
I would agree with Mr. DeMarco. I think those are decisions that need to be left with the regulator that Congress empowered to actually regulate the GSEs. We now have in place a very strong and powerful regulator that we didn't have before. The problem that we had leading up to the crisis before is that they did not have a powerful regulator. Congress has acted through HERA to actually create that. So those underwriting decisions should remain at the later level. And I know there's some concern about moving towards the 3% down payment, but I have to explain to you, the Center for Community Capital at the UNC school did research on borrowers with smaller down payments. And those borrowers, when they get a safe mortgage, they actually perform well. It was a study of borrowers all across the nation, and they actually were able to amass $38,000 in home equity even during the housing crisis. We now have the safe mortgage practices because of the strong regulation, and we now have the effective regulator.
So just make sure that you understand, I as a former licensed realtor, I sat at those closing tables and understood, you know, when my parents bought a home and the amount that they had as a down payment was very different than when I did, and it was very different than when I sat at my first closing and they slid a check across to both the seller and then the buyer. I'm assuming you would agree that having 0% down is a bad idea.
I'm saying those decisions are best left at the regulator.
So you would say that a 0% down would be acceptable?
I'm saying that those decisions are underwriting and should be with the regulator.
Okay, we'll move on. Mr. Pinto.
So I think we've just seen what happens when you leave it to the regulator. First of all, the Bureau said 41% was the proper DTI. It got pushback from the industry, went to 43, put a rule out at 43, got pushback from the industry, put in the patch, and then FHFA pushed Fannie and Freddie to go to 50. Regulators are not going to protect us from this. What the issue really becomes is we had a system where we had a debt-to-income limit generally across the country back in the early 1990s. It was 38%. You had compensating factors above that. I presented a chart that shows once Fannie and Freddie started moving away from that, those numbers just went to the stratosphere. They came back down, and then after the patch was put in place, they've gone to the stratosphere again. You have to have some limitations that act as friction in these sellers' markets.
Okay, and in the 10 remaining seconds, I wanted to talk about multifamily loans and real quickly, can these multifamily market function without the presence of GSEs? Yes.
What did he say?
Anybody else?
Yes.
Ms. Bailey?
Quick answer, please.
Saved by the bell.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you, Mr. Chairman, and thank you to all the panelists. I'm a strong proponent for affordable housing. And in cities, especially large cities like New York, that I'm privileged to represent, affordable housing is the absolute #1 public policy goal. So I strongly believe that any reform of GSEs should not in any way diminish resources for affordable housing and should usually or hopefully increase resources. So my question to Ms. Bailey and Mr. DeMarco, as we look at GSE reform, what is the most important thing that we can do to protect and even expand support for affordable housing? Ms. Bailey?
Thank you. We should definitely ensure that we move this system back towards average pricing. Again, pooling of loan risk, and I know I keep harping on this point, but pooling of risk and averaging the risk actually makes it more affordable. And we have to keep those broad-based duty to serve. Those goals were put into the charters when the GSEs were created, and they were also carried forward in the Housing and Economic Recovery Act of 2008. Everyone else in all the proposals that come forward, they want to give us aspirations. They don't have any strong enforcement mechanisms behind them. Without the strong enforcement mechanisms behind them for affordable housing, we won't see that produced. So right now in our current system, we have strong goals with clear mechanisms for enforcement. Give us stronger enforcement. We will see a move towards that end and get rid of this risk-based pricing.
Okay. Now,
Excessive risk-based pricing.
Thank you. Mr. DeMarco and Ms. Bailey, some people on the committee are advocating using the Ginnie Mae as a model for GSE reform and essentially transferring all of the Fannie and Freddie's responsibilities to Ginnie Mae. But this is a tiny agency, and it has less than 200 employees now, and I would say it has a very, very different business model and it doesn't even focus on credit risk at all now. Because Ginnie Mae only securitizes loans that have already been guaranteed by the Federal Housing Administration or the Veterans Administration. So I am really questioning and rather skeptical that Ginnie Mae is equipped to handle this type of responsibility, or that the Ginnie Mae model would work for a deeper, larger mortgage market. So in your view, Mr. DeMarco and Ms. Bailey, is this a good idea, or would using Ginnie Mae model for GS reform raise borrowing costs for middle-class Americans looking to buy a home?
So, Mrs. Maloney, as we'll find out this afternoon some of the details of the chairman's and Mr. Delaney's Ginnie Mae proposal, but I don't think it's correct to say that Ginnie Mae is going to be taking over all the functions and responsibilities that Fannie Mae and Freddie Mac have. As I understand these proposals, having co-authored one along these lines, Ginnie Mae actually retains a more limited functionality here, which is to be the issuer of a government-wrapped mortgage-backed securities in global financial markets so that the investors globally understand the backing of the American taxpayer on these mortgage-backed securities, but they are not undertaking all these other activities. And in fact, Fannie Mae and Freddie Mac would be transformed, and a lot of this would take place in the private sector. As to whether this is untested, look, Ginnie Mae is a $2 trillion securities operation today, and it's doing quite well.
But it doesn't have the risk model. And my main question is, would it raise borrowing costs for middle-class Americans, Ms. Bailey, in your view?
It would, and it would also put smaller lenders on unequal footing with their larger bank competitors. Ginnie is really complex and has a lot of complexity around it that would make it difficult for smaller lenders to manage. So we would also have to take that into consideration. So I agree with your statement.
Well, I'm sorry, I take some exception to that. If
I have one more question, and it's for you, and it's one of my favorite topics.
All right, let's
and
have at it.
Multifamily housing, if the chairman wants to give you more time after that, but I really, multifamily housing is very important to my district. Everybody lives vertically, not horizontally. And in the crisis, I think it's fair to say that multifamily housing performed relatively well. In fact, it subsidized the single-family businesses. So my question to Mr. DeMarco is, do you think that Fannie and Freddie's multifamily businesses are currently sharing enough risk with the private sector to adequately protect taxpayers? As I understand, the first tranche is guaranteed by the private sector.
The time of the gentlelady has expired.
He's so tough, but this is such a good question.
A brief answer from the witness, please.
I think that the model that Fannie and Freddie each use in their different models to risk share capital, risk share credit risk in multifamily is worth considering in what we're looking at with single family. It shows it can be done.
Thank you.
Time of the gentlelady has expired. Chair now recognizes the gentleman from Missouri, Mr. Luca Meyer, Chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman. And Mr. DeMarco, just to follow up on that question by Ms. Maloney, I know Mr. Azinga asked the same question basically with multifamily housing. You know, you made a statement in your testimony that we need to fix what's broken, preserve what works. And it seems the multifamily portfolio has done very well. And I think, as both my colleagues indicated, is there a way to look at that as perhaps a model or take from that the way to perhaps structure something for the single-family situation, or what's your...
The basic lesson that I would suggest from the way the multifamily businesses operate at Fannie Mae and Freddie Mac is that, in fact, there is, a meaningful amount of risk sharing that goes on in those systems. Until the conservatorships, there was virtually none in the single-family space. So effectively what's been going on with single families, we've been trying to start developing that kind of risk sharing. But it does take place in the multifamily space. What cannot be removed, however, is as long as Fannie and Freddie are operating as government-sponsored enterprises, they are competing in this commercial market from financing multifamily dwelling. They're competing with all the advantages that you get when you're a GSE. And in this case, within conservatorship, that advantage is the backing of the American.
Okay, when you say competing, you're competing against the private market, right?
Yes.
Yes, okay, thank you very much. I know that yesterday we had, under the leadership of Chairman Duffy, we had a hearing that focused on the cost of regulations with regards to the ability of consumers to be able to afford housing, because we found yesterday that like 32% of the cost to the consumers is actually federal, state, and local rules and regulations. We had a hearing, or had a roundtable with myself and my colleague, Mr. Budd from North Carolina, and Mr. Azinga here on Tuesday afternoon with some regulators, all the regulators involved, as well as some banks and some other interested parties with regards to some of the CECL rules that are coming out. Does anybody know, or have you heard of CECL before, know what this is about? It's basically where the banks have to, when they make a loan, immediately up front reserve more in their loan loss reserve for a potential loss. And so I was wondering, this is going to be a very, very costly situation for them. They're going to have to segregate capital. It's going to be, and eventually it's going to be a cost that's passed on to the consumer. If you've heard of this and are aware of this, would you give me an opinion on whether this is going to be helpful, hurtful to the consumers being able to afford housing, and then what effect it's going to have on FHA and Ginnie and or Freddie and Fannie, excuse me?
I can't answer all of those points, but I can address a couple of them. I mean, certainly, long duration assets like a 30-year mortgage, the CECL accounting creates new challenges for portfolio lenders that they didn't have before, and so that is going to have an effect on those businesses. The question is, if you create a reserve up front, should we be simultaneously re-examining the consideration of those reserves under capital rules? So if you're going to fundamentally change the accounting for reserves so that we consider reserves to be something other than what they traditionally have been, then have to ask, well, look, our bank capital requirements have been written in a way under an old reserving regime. We now got to reconsider those capital rules, given that we've changed the nature and the requirements around reserves. To your other point about this, if this does have an impact that makes it more costly for a bank to portfolio a mortgage loan, then it creates yet another regulatory incentive for those loans to perhaps be sold off into the secondary market to Fannie and Freddie rather than being held by the bank, because the costs of carrying that loan have gone up on a relative basis.
Well, we're discussing a while ago the difference between a 5% down and 3% down, so we're not talking about a whole lot of money there. So again, when you're looking at costs, 32% of the cost of making a loan or regulation, I mean, suddenly that's a pretty significant figure. And so if that is significant enough, whenever you were discussing a minute ago between people getting a loan when they have 5% down or 3% down, to me this would be a barrier, would it not?
Yes.
With increased costs?
Yes. In fact, I mean, you're quite right. I point out in my written statement that these kind of barriers are in fact inhibiting bringing affordable housing supply onto the market, both in terms of rental and in terms of single family. And I actually cite an Obama administration report pointing to some of these, especially at the state and local level, barriers and some ideas about how to mitigate some of them.
Thank you. My time is up. I yield back, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes another gentleman from Missouri, Mr. Clay, ranking member of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank the witnesses for being here. Before I get into my questions, I wanted to note that my friend and colleague, Representative Duffy, brought up the issue of race in consideration of risk. And it's not the risk that is involved here. It's really the institutional racism that exists. We know during the housing crisis that borrowers of color were steered into high-priced loans, and communities of color now are targeted by predators. What communities of color are looking for is fairness in the housing market, in lending, and not being charged what I call a black tax for being black, being charged more for a mortgage product. So it's not about risk. It's about the institutional racism that exists. Just so the panel understands that, and my friend from Wisconsin understands that, we are asking for equal protection under the law so that we can also realize the American dream and not the American nightmare. And I intend to have that conversation with Mr. Duffy and explain it to him on what actually happens. But my first question is for Mr. Pinto. Mr. Pinto, saving up for a down payment is one of the biggest barriers to home ownership. That is why responsibly underwritten low down payment mortgage products backed by Fannie Mae, Freddie Mac, the Department of Veterans Affairs, and the Federal Housing Administration serve an important role in expanding access to home ownership. In fact, the Department of Veterans Affairs has been backing zero down payment mortgages for years, with a very successful track record. You have been very critical of low down payment loans. Do you contend that low down payment loans cannot be responsibly underwritten, or do you contend that veterans should not have access to zero down payment mortgages?
So thank you for that question. What I contend is that credit easing, minimal down payments, high debt ratios, et cetera, in a seller's market with a 30-year loan ends up getting capitalized into higher prices. And that doesn't help anyone, and particularly doesn't help low-income buyers. I presented data from 9 million loans that shows that. What I have proposed, I think I've mentioned this at this committee before, is excuse me, a zero down payment loan, 100% LTV, with a 20-year loan term. The problem with all the subsidies you're talking about is they get ladled on top of the 30-year loan, and they get capitalized into higher prices. The solution is to go back to a 20-year loan and use that subsidy to increase the buying power to allow the 20-year loan, which amortizes much faster, to be gotten by this lower-income buyer. I call it lift home, low-income, first-time buyer tax credit.
Okay, well, what about those who are recent graduates of college who are heavily indebted with student loans? How do we address them when you and I know that their credit scores are lower because of the student loan debt? How do we address that?
I think Congress has to look at the student loan program, which has exploded in the last 5 or 6 years to I've lost track, 1.4 trillion, and fix that. Having said that, the research I've seen shows that the student loan debt, and this is going to sound counterintuitive, is not that much of an impediment, mostly because most of the buyers, or many of the buyers, are in deferral or on income-based programs. Therefore, it's not creating the debt-to-income ratio problem that's commonly thought.
How about another solution and allow the mortgage companies to buy the student loan and roll it into the 30-year mortgage? What about that?
Taking something that was supposed to be something paid back over hopefully 5 or 10 years and turning it into a 30-year debt, it doesn't make any sense to me.
I give.
Time of the gentleman has expired. The chair now recognizes the gentleman from Kentucky, Mr. Barr, chairman of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman, and thank you for having this hearing on this, as you referred to it, the not-so-happy anniversary of American history involving the day that the federal government took over Fannie Mae and Freddie Mac. And while the GSEs admittedly provide liquidity to the housing finance system, let's face it, Fannie Mae and Freddie Mac were more than mere bystanders in the 2008 financial crisis. They were, in fact, at the epicenter of that crisis because they were thinly capitalized. They bought risky loans with very low down payments. And with all respect, contrary to Ms. Bailey's revisionist narrative, the absence of risk-based pricing in loans purchased by GSEs was precisely the problem. And the fact that GSEs fueled origination of mispriced loans that put people in homes with mortgages they couldn't afford was exactly the problem. That was what caused the financial crisis. I just think that if we ignore that basic fact, we're willfully disregarding history, and we're bound to repeat history, as Mr. Pinto was warning us here today. I do want to compliment Mr. Delaney and our chairman for working in a bipartisan manner. I have a lot more of studying to do and looking at the proposal before us that they've worked on. I want to learn more about it, but it does seem to me that putting layers of diversified private capital in a first loss position will help ensure more accurate pricing of risk and reduce the number of bad loans. It seems to me that that is exactly the direction we want to go in to have better pricing of risk. Let me move to a question, and let me ask Mr. DeMarco. The QM rule that we've worked so hard, the CFPB worked on, our recent statutory changes where we injected a new portfolio safe harbor for the QM rule. Explain to us a little bit more your belief why we should apply a comparable QM rule to the GSEs, and I do note that the bipartisan proposal would do that.
Right. So the qualified mortgage rule was considered by many involved in developing that legislation as a key aspect of Dodd-Frank. It statutorily ruled out certain loans or loan characteristics that were thought to be fundamental to the financial crisis. It allowed the BCFP to then write additional rules governing what constituted a qualified mortgage. And so that rule was written, and so it applies to all mortgage lenders. It says, all right, here's the set of standards for what constitutes a qualified mortgage. But then it said, but if the mortgage is acceptable to or financed by Fannie Mae and Freddie Mac, then that's okay. Right? And so we really created, two different standards: a qualified mortgage rule unless it got financed through a government-sponsored enterprise. Well, people are, the industry, borrowers, advocates, everybody seems really happy with this QM patch. Well, we can't have it both ways. Either the QM patch is the right way of sort of articulating what constitutes a qualified mortgage, in which case we are restricting access to credit through the BCFP rule, or the BCFP rule is right, and for some reason we're creating this huge loophole.
And Mr. DeMarco, to Ms. Bailey's concern that there would be excessive pricing of risk, wouldn't the portfolio lending model provide kind of an escape valve that would be safer than the originate to distribute model, so that if we build upon our work in the regulatory relief package that is now law, and allow for, if there is a mortgage that's out there that is outside of the QM rule, but a lender with full view of the borrower's ability to repay, we're willing to take that risk, retain that risk in portfolio. Is that a way to maybe address Ms. Bailey's concern that we want to provide access to affordable housing, but do so in a safe and sound way?
Yes, sir.
Okay, and Mr. Pinto, in my remaining time, let me just ask you about credit risk transfers really quickly. Some banks are concerned that while we like to see the credit risk transfer increasing, some banks have stressed that bank capital rules may impede credit risk transfers. Are you concerned about that?
I am concerned that there should be a level playing field. I'm also concerned that these credit risk transfers need to be upfront, transparent, and put in place at origination. They should not be done in the murky black box that they're being done today by the GSEs.
Yield back. Thank you.
Time of the gentleman has expired. Chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. I also want to thank all the panelists for your participation today. It's been very helpful. Ms. Bailey, I grew up in the South Boston housing projects, the old colony housing projects, with a lot of other families that were struggling at the time. My dad had he used to say, at times we had to save up to be poor. And he was only half joking. So we had the blessings of a home in public housing. The housing was built probably in the 1940s, right after the Second World War. And now we're trying to rebuild it. We're about halfway done rebuilding some of those units. And but my problem now in my district, which is a big part of Boston and Brockton and Quincy and then a bunch of towns on the South Shore, is that not only do I have a problem finding housing for people who are struggling, like my family was, but I'm struggling to find affordable housing for firefighters, teachers, nurses, construction workers. And so there's a gap there. Now I need workforce housing. They're getting priced out. It's just insane. So I know that Chairman Hensarling sent a letter to Mel Watt back in February criticizing him for making Fannie Mae and Freddie Mac continue to contribute to the Affordable Housing Trust Fund and the Magnet Fund. What is the status right now of our public housing, and is there anything in the formula that might help my nurses, my teachers, my Teamsters and construction workers? firefighters, police?
Thank you for the question. Yes, those funds need to be fully funded, and I thank you for sharing the background that you are sharing. The very pricing segmentation that I talked about earlier is hurting working people across the country. So absolutely, those things should be fully funded. And I need to just, for one moment, just kind of respond a little bit to the response about Fannie and Freddie and the revisionist history. Most of the mortgages that Fannie got in trouble for were all A-mortgage loans. They were actually financing and chasing the mortgages for upper income borrowers. These were not working families like the ones that you were just talking about. Right. So it's really important for us to really highlight that. They were no-doc loans to A borrowers, and 10% of those were GSE loans. So it wasn't the subprime loans that had been raised. Right. And then it's also really important for me to make sure that we're talking about, for the risk-based pricing, we're talking about catastrophic risk, and we need to get specifically at the G-fee cost. The G-fees price for 75% of that. So when I'm making that point, that's exactly what I'm going for. The Housing Trust Fund and the Capital Magnet Fund need to be fully funded because we know increasingly more and more Americans are paying more than 50% of their income to cover their housing costs. The Harvard Joint Center report that just came out made that fact really clear and clarified that working families just don't have, wages haven't kept up. They have real wage stagnation. So you just don't have the resources to cover the increasing costs around housing. So price and segmentation really hurts them and stifles their ability to get even quality rental opportunity as well.
Well, thank you. I know that in other areas, in health insurance and in auto insurance, we spread the risk. We don't put all the risk on the sickest people and make them pay the greatest amount. We try to figure out, that's the nature of insurance. You spread the risk out so that we all absorb it, and then if you're lucky enough to be healthy, you pay a little bit more, but if you do get sick, then you've got some relief there. I realize that there's a blending that needs to happen here. I think Mr. DeMarco has touched upon it, where if we can shift in a balanced, if we can rebalance the risk, I guess, between the GSEs and the private market, find a way to do that, because we've got to shift that over, but do it in a way that maintains our ability to offer a 30-year fixed mortgage at a reasonable interest rate. That is hugely important to average Americans who are trying to get out there and buy their first home. So. Mr. Chairman, well, I want to thank the witnesses again for your participation, and I yield back the balance of my time.
Gentleman yields back. Chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman, for calling this important hearing. Thank each of you for coming and offering your expertise today. There are numerous options that we'll consider to restructure the GSEs with the goal of returning them to a financial health. With this, they range from simply taking them out of conservatorship to converting them to private corporations or creating a new government agency. In your opinion, Mr. DeMarco, Mr. Pinto, which of these options would provide the most future stability for both the markets and the consumer?
In my view, creating private companies backed by private capital in a competitive market has the best long-term outcome, both in terms of stability of market as well as innovation and provision of credit to families.
Yes, sir, Mr. Pinto, and try to.
I would agree with that. I would just add,
that.
without a government guarantee on those companies, and I would also add that we need to have an administrative solution, because even if you put in place the proposal that the chairman and Mr. Delaney have put forth, it would take many, many years for that to actually come to fruition. We are in a problem today where we have house price boom 2.0. And what I'm concerned about are the low-income buyers, the minority buyers that are in neighborhoods that have prices that are at unsustainable levels, and they're going to get hurt when that reversion to the traditional trend occurs, and it's going to be in all of your districts. And that's what I'm concerned about. There's nothing in a legislative solution that's going to address that. It can only be addressed with administrative solutions.
Well, let me ask you this. If they're released from conservatorship, how would they be recapitalized?
I don't believe they should be released from conservatorship. I think they should be wound down.
Yes, sir. Mr. Marco?
Yes, Congressman. I believe Congress needs to decide what the final disposition of them is, but I would not return them as GSEs.
Ms. Bailey and Mr. Swaggle, Dr. Swaggle, the concern with the GSE reorganization comes from small community banks. Small lenders fear the development of additional guarantors controlled by megabanks, which could result in volume discounts. These discounts would leave the smaller banks at a distinct disadvantage. What are your plans to ensure that small community lending groups will be able to compete?
Right now, as the system works, small lenders have access to the cash window on equal footing with their large bank competitors. A lot of the proposals that we've discussed could really impact the level of equal access for small lenders. So I agree with you that small lenders need to be able to operate in their own unique way without having to do pricing purchases through their large bank competitors. That puts them at an unfair advantage because they just can't get the volume discounts that the larger lenders are able to get. So I agree with that point.
Dr. Swaggle.
I'll just add that this was one of the worst aspects of the old system, was the disadvantage of small lenders. And Chairman Hensarling's plan, the Corker Warner, DeMarco Bright, all of these ensure equal access for small lenders, and that's important.
Mr. Pinto, you have said in your testimony that current policy is creating a home boom and therefore making entry-level homes less affordable. In your opinion, what policies could be put in place to make housing affordable for low to middle-income home buyers?
Thank you for that question. As indicated earlier, the problem with all of the subsidy, cross-subsidy, duty to reserve, all of these programs is they take the existing 30-year mortgage, which itself is a very highly leveraged instrument, add a lot of risk to it, and then somehow provide some subsidies on those loans, some cross-subsidies. The problem is that gets capitalized into higher house prices during sellers' markets, which we're now in the 71st month of a national sellers' market. The answer is to say if you want the 30-year mortgage over here, that's fine, but if you want to do something for low income, let's take the 20-year term and let's figure out how we provide them an ability, and I've proposed this first-time homebuyer tax credit. You take the tax credit, you buy down the interest rate, and you do some other things because it's a lower risk loan to begin with, et cetera, and you then equalize the cost. So the 20-year loan now has the same monthly payment, roughly, as the 30-year loan, except it amortizes much more quickly. You now have a wealth-building machine for low-income buyers. They get into the house, and you'd have zero down payment. That is the solution.
Thank you. Ms. Bailey, quickly, are you encouraged that with the economic policies in the last 2 years that have been put in place, that the unemployment for African Americans is at an all-time low? Does that encourage you to believe that they will have greater access to home ownership in the future?
Mm-hmm. No, sir. And I have to say, when people of color have been in the marketplace, they've never been well served or fairly served. And because of that history of discrimination, they've often been targeted with more expensive credit.
But you do acknowledge that unemployment's at an all-time low? Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Well, this has been quite a newsworthy morning. When I open up the opinion section of the Wall Street Journal, ladies and gentlemen, this morning, I was greeted by my friend Chairman Hensarling's op-ed piece touting a bipartisan deal that he has struck on GSE reform. And I really appreciated that. Chairman, you touted in the paper, the Wall Street Journal this morning, you said, and I quote from the Wall Street Journal, you said, reduce taxpayers' risk, codify into law an explicit government guarantee, and increase market competition. These are all great things, and I certainly look forward to reading and learning more about it. And I certainly encourage everyone to look at this morning's Wall Street Journal. I think that the chairman has put out some excellent points. However, until I see the full text, I remain just a bit skeptical because it wasn't until this morning in this surprise editorial in the Wall Street Journal that showed the willingness of the chairman to agree on some issues that, of course, we've had some differences. Because prior to this editorial this morning, the Republican side would not agree to the 30-year mortgage, wouldn't agree that it would remain intact, wouldn't agree, even more importantly, to ensure affordable housing and rental housing is supported. Before this morning op-ed piece, it quite honestly was only the Democratic proposals that guaranteed these proposals, very much needed. That 30-year mortgage guarantee is the bedrock of our financial system. And I say this as one of the original co-sponsors of Mr. Delaney's bill, Partnership to Strengthen Homeowners, Home Ownership Act, H.R. 1491. But I certainly welcome this sterling example of leadership on the chairman's part here to work in a bipartisan way in these final 3 months. It sort of reminds me of this past week when we went through a profound exercise in this nation during our services for the late Senator John McCain, and we found that there was a great cry in this nation for us to show bipartisanship, Republicans and Democrats working together. But it's also worth noting that to the American people that it was Democrats under the sterling leadership of our ranking member, Ms. Maxine Waters, that has been fighting and been our protector on many of these issues. And it's so exciting and glorious, quite honestly, to see our chairman and our ranking member. And I will tell you, we are blessed in this committee to have the kind of knowledgeable leaders in our ranking member and our chairman. And quite honestly, it's going to be a disappointment for my friend, Chairman Henseling, to leave. We came together, so I have great affection for him. And I do urge everyone to read this op-ed piece today. It is a tremendous article, and it's something that I think will provide a way for us to go forward in a bipartisan way. Now, in my last, well, I only have 18 seconds, but let me just say, the GSEs did not cause this crisis, and the information is there to do it. It was caused by private activity in the housing market, anchored in Wall Street, and staring individuals that they knew they couldn't pay into that. I yield back. Thank you, sir.
Time of the gentleman has expired. Chair now recognizes the gentleman from Florida, Mr. Ross.
Chairman, thank you, and I thank the panel for being here. I also want to acknowledge, Mr. Chairman, your op-ed piece today. It was very refreshing to see, and it's even more refreshing to see that you and my good friend from Maryland, Mr. Delaney, are working towards a bipartisan resolution of what is a powder keg waiting to explode again that will work to the detriment of the taxpayers of this country. And as I look at our regulatory system in insurance and think that we have, and I know that we have better than any across the world, our state-based form of regulation, I'm concerned that we should maybe take a page out of our European friends and who do not have GSEs and subsidized mortgages in their housing market and yet seem to do very well. So as I begin my questioning, I do want to lay the predicate that, of course, this issue of GSE reform has been before a majority of a Democrat Congress and now a majority of a Republican Congress. Eventually, it will collapse if we don't make a change. And no one party has a monopoly on good ideas, and therefore a bipartisan effort is what is necessary to get this done. And so I laud your efforts into that Mr. DeMarco, in your testimony, you write that, quote, the GSEs operate with a substantial advantage that guarantees they will be able to offer better terms and lower pricing than any other market participants. What are the dangers of not opening up the markets to other charters?
You concentrate risk, you stifle competition, and even more important, perhaps you stifle innovation.
And without reform, do you believe that we will continue to see the GSEs entrench themselves further in the market?
Yes, sir.
I mean, there's no other alternative. And there is capacity out there, is there not, in the markets?
There is.
And I would, as much as a purist I would like to be and say the government shouldn't be in the business of business, the only way we can actually address this is to have a combined effort of public-private partnerships where the government is involved in some form as a backstop. Would you not agree? Unfortunately, from a political perspective?
I think that it actually can help perfect markets and help markets to work better with a well-defined role for the government.
And Mr. DeMarco, I agree. A 30-year mortgage has been the saving grace for many families. The ability to get into a mortgage, to affordably, and to be able to pay for it and move on to another mortgage later on. Now, would any way, shape, or form these reforms that we're proposing adversely impact the availability of a 30-year mortgage?
No, I don't believe so.
What about rates? I mean, the affordability of rates has been at an all-time low, somewhat suppressed, but nevertheless there. Would market factors or forces allow, in a competitive environment, allow for at least a stabilization of affordable rates no different than we have today?
Yes, I think so.
Dr. Schwegel?
I agree, and I'll just add on the risk-based pricing, the actions taken by the Fed are much more important. And so in some sense, criticizing Ed on what he did with the risk-based pricing, the criticism would be of Chair Yellen and Chair Bernanke, which seems like an unfair criticism.
I appreciate it. Anybody else? Mrs. Bailey?
I would say in the current system, we're likely to see rates go up. And if not
no spike. There'll probably be a spike before stabilization.
Not in the current system, but if we move towards these other untested systems, because what they do is they bring in a level of anxiety, and they say bring in these new market actors that won't be subject to our nation's fair lending laws. So our ability to make sure we have the fairness and equity that the system currently has is moved away. And then the affordability. We have a $4 billion subsidy in the market right now. Those proposals say that they're going to bring in an extra $1 billion. However, what they fail to realize is once you actually calculate the cost, that's not going to be the outcome. And the market at other times, when more borrowers of color and lower wealth families were actually able to get the mortgage credit they deserve, actually had a much higher subsidy. So if we look at a better time frame of this lending, we will see higher rates of subsidy. Right now, the market isn't doing
higher rates of subsidy than are today by the GSEs?
Say that again.
You're saying higher rates of subsidy than exist today by the GSEs?
We would see more affordability for more borrowers because right now the Fannie Mae and Freddie Mac are not serving the borrower pools that they have served in the past. So we're missing out on an opportunity to really go back and do some things right. And I have to remind the committee, there was a time where we looked at loans to people of color and lower income families differently, and we let them get perpetuated with abusive financial practices.
I appreciate that.
And we've got to bring them right into the center of this debate. And any reform that we do has to have them at the center. 7 out of 10 future buyers, so this is a safety and soundness concern for our market, are going to be people of color. You can't build a system without figuring out how to bring those people in. Wealthier borrowers, homeowners won't have anybody to sell their homes to.
I appreciate that, Ms. Bailey. My time is expired.
Time of the gentleman has expired. The chair now recognizes the gentleman from Maryland, Mr. Delaney.
Thank you, Mr. Chairman, and I want to thank you and the ranking member for this hearing. And Mr. Chairman, in particular, I want to thank you for the opportunity to work with you on the bipartisan housing finance reform proposal that we are releasing today. I think it reflects some of the type of great principled compromise that you typically see associated with legislation that really reflects the common good of the citizens. And I appreciate your efforts to work with me on this, and I appreciate the opportunity to work with you on this. And I think we came up with a good product. And also, like most good bipartisan compromises, we were finishing it at about 11 o'clock last night. So it had all the elements of a good deal. But in particular, I think it does 5 things that are really important. First and foremost, it stabilizes the housing finance system in this country. which, let's face it, the U.S. housing market is the second largest fixed income market in the world, and it needs to be stabilized and it needs to be safer, and we need to put the taxpayers in a situation where they have less risk in the future and that they will have a housing system that will have more private capital, more discipline, and it can be an enduring part of the American financial system. So I believe it does that. Second thing it does, and this is very important, it's been a core element of the democratic principles that the ranking member has led us on since I've been in the Congress, which is preserving the 30-year fixed rate mortgage, which is important to Americans' ability to afford housing and have their housing asset be part of their long-term portfolio. It has a meaningful increase, or at least it creates a pathway for a meaningful increase in terms of the amount of capital allocated to affordable housing. I think we have an affordable housing crisis in this country right now, and I think it's a very, very significant problem, and it's pricing so many Americans out of the opportunity to own a home, for them to raise their family in that home, and to have the stability that a home provides and become part of a community. And it's been my view for a long time that as a country, we have in general probably over-allocated some of our resources towards housing generally at the expense of not allocating enough resources towards affordable housing in particular. And I believe this proposal that we've come up with, by creating a pathway for a fee to go on every mortgage securitized, we'll start reallocating some of that capital towards the really dire need we have for more affordable housing in this country. The fourth thing it does is protects a lot of the important consumer financial or consumer protections that were embedded in Dodd-Frank, which I think are important. And finally, it preserves the part of the GSEs that has worked quite successfully, which is the multifamily model. So the bill is explicit about ensuring that those businesses within Fannie and Freddie will in some shape or form or fashion be reconstituted with the benefit of the explicit government guarantee so that they can continue to provide the financing that they do in the multifamily market. So again, I don't have any questions for our witnesses here. I appreciate their testimony. I just really wanted to thank you, Mr. Chairman, for the opportunity to work on this bipartisan bill, because again, I believe it reflects the type of principled compromise that we need in this country, and I think it's a good way forward for this Congress or for future Congresses. So with that, I yield back.
Gentleman yields back. Chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman. Thank you, panel, for being here today for this important discussion on this anniversary. Mr. DeMarco, in your testimony, you talked about how moderate income households are more susceptible to income volatility, which is more prevalent today than in the past. You continued by suggesting that housing policy and our housing finance system need to become more tuned to this challenge so better solutions may be found. Can you give an example of some policy changes that would better accommodate income volatility among moderate income homeowners?
Certainly. So we talked earlier about QM rules and more generally various underwriting rules that are based upon sort of fixed ratios. Well, that becomes pretty challenging if someone has an income source that is subject to this kind of volatility. So rethinking some of these standards whereby we take account of volatility so we don't, so we get folks in mortgages that are actually sustainable is I think a very important thing. I would add one other thing, Congressman, and that is it requires, in some sense, rethinking not just policies, but about mortgages or how we go about constructing mortgages. If we know that there's income volatility there, what can we be doing on the front end to build in some shock absorbers for families so that they can weather those temporary disruptions in income flows?
I'm wondering if you could recap, in your view, how a more streamlined and transparent housing finance system with greater private sector participation, as you discussed in your testimony, would benefit homeowners. In what way?
Because you'd have a much richer pool of lenders competing to provide this financing, but to have alternative ways of providing that ultimate financial support than
and what happens when you have more lenders competing?
You get more innovation, you get better outcomes for consumers.
Better prices?
Yes, sir.
Mr. Pinto, as you know, between the GSEs and Ginnie Mae, the federal government continues to dominate the secondary mortgage market. How does the current level of GSE involvement compare with historical levels?
So today, the GSEs are responsible for about 50% of all mortgages. Their percentage in history has ranged from something around 50% to maybe 35, 40%. What's somewhat different is FHA and the VA and rural housing now comprise about 35%. And so the 85% being guaranteed by the federal government is extraordinary.
Well, how compare that then with the historical trend and how it relates to home ownership levels?
So home ownership levels actually in the United States, if you look broadly, have virtually unchanged since the early 1960s. I'd only point out that's about the time the 30-year mortgage became more commonplace in the United States. It wasn't even authorized by Congress until 1954 for existing homes for FHA. So it was in the early 60s that the 30-year loan became commonplace. We've made no progress on home ownership virtually since then.
In your testimony, you wrote, for many decades, U.S. housing policy has relied almost exclusively on increasing borrower leverage in an ineffectual attempt to make housing more affordable. Instead, the result in a seller's market, again, we've been talking about the seller's market, is to make homes less affordable. For the same reason, policies such as duty to serve, affordable housing fees, and cross-subsidization have the same effect, higher prices in a seller's market. Can you envision a scenario in which housing becomes more affordable as a direct consequence of scaled-back federal support for the housing market?
Absolutely. And I presented in my testimony an example of the Rural Housing Services, which is part of the Department of Agriculture. They followed the Bureau of Consumer Financial Protection's admonition that the patch was to get you down to 43%. So what did they do in 2014? They announced that they were going to lower their debt-to-income ratios maximum to 41 and require compensating factors above 41. Fannie, Freddie, FHA, VA did the exact opposite, and you've seen the data that I presented. So we then looked at, well, what happened? So the prices of FHA loans during this time period that were paid by consumers went up 25% in 5 years, nominal terms. Incomes did not go up 25%. Inflation hasn't been 25%, yet the prices went up 25%. At the lower end, they actually went up even further. What happened with rural housing? Prices went up 9%, about the same as inflation. What also happened? Debt ratios went down, and the prices were much more stable. Therefore, people were able to buy the houses with less leverage, and in fact, we looked at the incomes of the buyers, and the incomes of the buyers in rural housing went up about the same percentage as the income of the buyers in FHA. You get the exact result that you just described. You get a better result, not a worse.
I want to thank the panel for your insights and being here with us today, and I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman. I thank the ranking member and the witnesses for appearing today. And if I may, with no disrespect to anyone else, I do want to thank you, Ms. Bailey, for your courage. I thank you for your courage because you have, on more than one occasion, tried to explain that race is a factor. I'm a capitalist. I believe in free markets. But if you have invidious discrimination in the market is not a free market. Would you kindly explain what you have been trying to get across as it relates to invidious discrimination and race in the marketplace, especially as it relates to lending?
Yes, sir, and thank you for that point and for the question. The point is, when we decided to put tremendous resources in housing finance policy following the Great Depression to bring America forward and offer this idea of home ownership to more Americans, we did it in a way that excluded people of color. We did it in a way that would not allow federal insured mortgages to go to African Americans, Latinos, other people of color. And by doing that, we create a historical wealth inequities because most Americans have built up their wealth through home ownership. The equity that they get from their mortgages is what they've passed on across generations to pay for them to go to college, to start businesses. So that means that a whole cohort of Americans did not have equal access to that outcome. So now, today, African Americans, Latinos, and other people of color have smaller down payments because they don't have that wealth equity to pay forward. And then because of broader societal discrimination, we know that they also have lower credit profiles. So when we take and think about price segmentation in the market today, and we don't take those factors into consideration, and we put in policies that reinforce that, then we just continually reinforce that legacy of discrimination, and we hurt the very borrowers that a future system depends.
Thank you very much. Mr. DeMarco, if I may, you are intimately familiar with what I'd like to address. You know what the yield spread premium is. You know what the yield spread premium is.
Yes, sir.
And you know how the dastardly yield spread premium had an adverse impact on minority communities. Is this true?
I'd be even more general, Congressman. I'd say that there were a number of lending practices that were very abusive of minority communities and of other borrowers as well. Yes, sir.
Absolutely, I agree with you. And for edification purposes, the yield spread premium allowed a broker, an originator, to qualify a person for a loan at 5%, and then walk out and shake that person's hand and smile in his face and say, "Good news, we got you a loan for 9%. Wasn't right, wasn't fair, but it did encroach upon the free market. And many people from minority communities who qualified for lower loans, who would have been able to keep their homes, were into foreclosure because they were pushed, if you will, into these high-cost loans, notwithstanding a good credit history. That actually happened to people. And you're aware of this, Mr. DeMarco. And by the way, I'm not condemning you, but you are the person who knows most about this of the people on the panel, in my opinion, because of your years of service with the federal government. Do you concur with what I've said, Mr. DeMarco?
I believe instances like this did happen, Congressman, and I'd again take you a step further and say that private markets require and depend upon ethical behavior by those involved.
Okay, so the point that Ms. Bailey is making is salient. It's something that has to be considered. But here's my closing point, since I have but 20 seconds or less. Whenever we have the opportunity to do something about invidious discrimination, we find clever ways to work around it and just go on with life as it is. I refuse to ignore what is obvious. And at some point, we have to take what Ms. Bailey has said seriously. Thank you, Mr. Chairman. I'll yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Illinois, Mr. Holmgren.
Thank you, Chairman. Thank you all. Appreciate you being here. The Federal Home Loan Bank of Chicago serves my district and works to provide liquidity to member institutions to support the housing finance system. During your tenure at the FHFA, Mr. DeMarco, you began the rulemaking process to reevaluate FHLB membership requirements. When Director Watt finished the rulemaking in 2016, it resulted in a new definition of insurance, which excluded captive insurers. FHL Bank of Chicago has 3 captives that will eventually lose their membership in the bank because of this change. In a cooperative like the Federal Home Loan Bank, the loss of these members and their significant borrowing would reduce the scale that the Federal Home Loan Bank of Chicago and limit its ability to serve its members and their communities. I wonder, there's been a lot of discussion today about the need to increase the role of private capital in our housing finance system. And so I hoped you might speak to the role that you see the Federal Home Loan Bank already play in funding banks, insurers, and other mortgage lenders that choose to hold mortgage loans on their balance sheet instead of selling those loans to Fannie or Freddie? And would you agree that we could increase the role of private capital in our housing finance system by shifting more mortgage lending to balance sheet lending and away from securitization through the enterprises? I wonder, do the Federal Home Loan Bank's advances to their members tend to support balance sheet lending?
Yes. Basically, Congressman, yes to all of that, but I suppose you want a slight elaboration. First of all, the Home Loan Bank system, and the Home Loan Bank of Chicago in particular, have shown some real leadership in demonstrating the capacity to credit share, that is to syndicate credit risk through what they do, through providing an alternative avenue for aggregating the loans of lenders, particularly of small lenders. They have been especially good at providing financing support for small lenders and for large lenders in terms of being able to manage mortgages on their balance sheet by getting the funding flexibility that home loan banks provide.
Thanks. I wonder if you, just trying to see what other things I want to cover here real quick. While I understand the concerns associated that many have, I do understand it, of potentially expanding the footprint of the Federal Home Loan Banks by allowing captive insurers to maintain membership. I wondered, is it fair to say perhaps that with some other regulatory changes, captive insurers could provide a way to actually attract private capital into the market while shifting mortgages away from Freddie and Fannie?
I believe that is possible, and I would, since the subject of this hearing is housing finance reform, I'd take it a step further in the general direction you're headed, which is I think it's important for the Congress to consider liquidity sources for our financial system and housing finance reform and what the proper role of the Federal Home Loan Banks in being a source of liquidity is. And I think that this question about captive insurers is really one best addressed by the Congress, because when the Congress created the home loan banks, just like with Fannie and Freddie, and wrote their mission and gave them these privileges, but then set some limits, the limit was really, about, who's eligible for a membership and how that membership is structured, because Congress knew it was providing a set of benefits to this system. It wanted a closed system to benefit mortgage finance. Life insurance companies were part of the original membership of the home loan bank system because in 1932, when the system was created, life insurance companies were a big source of capital that financed mortgages. Our system's much different today. The risk with captive insurance is there's a trade-off. Certainly, captive insurance companies can be structured in a way in which they're an important source of capital to support housing finance, but if this isn't done properly and you just simply allow captives, then you can have all kinds of companies, non-financial companies, companies with no interest in housing, being able to gain access. And I believe that that's part of what motivated the FHFA's final rulemaking.
Just one last question on that, and I think maybe just getting into more specifics of how do we find that right balance. How would you view an expansion of membership that came with higher collateral requirements or perhaps even restrictions on types of eligible collateral in a way to ensure that those that do gain membership do so in a way that doesn't significantly increase the risk of the entire Federal Home Loan Bank system?
Right, I think it's quite important if one is to consider changes in the membership construct of the home loan bank system that for the existing members, almost most of which are insured depository institutions, that we pay careful attention about how that alters the risk profile and whether we're putting insured depositories at risk through how we do that. So some of the ideas you suggested are ways of mitigating the risk, but let me simply say it is a very important question, one that needs to be carefully thought through.
I appreciate that, and definitely agree with you that I think it's something Congress ought to address and ought to talk about, and we certainly would look forward to suggestions or advice from the entire panel of how to do that well. My time's gone by too fast. I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Arkansas, Mr. Hill.
I thank the chairman. I thank the ranking member for doing this hearing. I agree with the ranking member. It's a long time in coming in my 3.5 years in Congress that we have a comprehensive hearing on this topic. So I thank the chairman. I thank he and Mr. Delaney for working on a comprehensive proposal. But abdication about responsibility in the secondary mortgage market is a bipartisan opportunity. There is no one, contrary to the ranking member's emphasis on this administration and this Congress. This is a problem that started 35 years ago. It has been dealing with it's been abdicated by numerous administrations, both Democratic and Republican, and I don't remember sitting here for 3.5 years hearing any comprehensive proposal to change the secondary mortgage market by Jack Lew during the Obama years. my shelves are littered with studies about what's wrong with Fannie Mae and Freddie Mac in the secondary mortgage market. We have this historic one, 1980, Ronald Reagan. We have the one I had to work on as a staffer at the Treasury, 1990, and it had a supplement, smaller, 1991. And the list goes on and on. And we ought to all be embarrassed, I think, by passing Dodd-Frank and having the Financial Crisis Commission and not pursuing active change in this area. So thank all four of you for being here today and sharing your views. A few quick questions for the four of you. Do you support a recap and release of the two secondary mortgage market entities? Just give me a yes or no. We'll talk some more. It's not a trick question.
No.
No.
Fundamental reforms have to happen first.
Thank you. No. Thank you. I think that's important because I think that is an important statement on your part. It reflects across policy thinking apparatus. And that is something I think is very important, is that we don't just simply turn the page and go on. And I agree, Ms. Bailey, that the new regulator has a lot of power. And so I look forward to a new appointee at that agency and hear their considerations. One of my concerns is, and I was looking back at Congressman Frank's work on Dodd-Frank. He said the profligate availability of credit is a major reason for the current problem. The housing crisis, too many loans were made to people that shouldn't have gotten them. We need to reduce the pattern of people getting loans who shouldn't have gotten them because they couldn't repay them. That's what we think we've achieved in this bill. And he's referring to Dodd-Frank, and he's talking about the ability to repay and the QM process. So, Mr. Pinto, I think you've done a great job with your research about how this patch issue, allowing the GSEs to get out and around the debt-to-income ratio that you talked to the ranking member about. She also challenged you that those aren't necessarily bad loans. And so when you see FHA and the VA going up over 50% debt-to-income ratio, that also comes with a higher risk index that you outlined in your testimony. You didn't really talk much about that, but the GSEs have a 12% high-risk mortgage in their portfolios. Back in 2012, it was 10%. Now your data shows that it's 29%. So it's 3 times higher. They've made 3 times higher risk loans in their portfolio since the patch. So the systemic risk is growing in these unreformed GSEs. The issue of mission creep. I've read a lot recently that your successor, Mr. DeMarco, Mr. Watt, is allowing a series of expansions of power of Freddie Mac and Fannie Mae. And this is an oligopoly. This is government power that's incurring now on the private mortgage insurance business, on the commercial lending business for purchase mortgage service rights. Can you talk to us in the minutes we have remaining about your views on expanding more pricing and market power by these two entities?
I think it contributes to the sort of systemic risk that was at the heart of the financial crisis 10 years ago. And just to point out one example, what you said, I mean, the providing advances to non-bank lenders for their mortgage servicing is competing directly with a traditional function that happens in our financial system without the benefit of government backing. And by using Fannie and Freddie to fund that, we're using essentially the ability to raise money at taxpayer cost of funds to provide that subsidy.
Well, it takes a lot to pay that rent on a $700 million building, so that's important. Mr. Pinto, quickly.
Yeah, we had a conference on this a couple months ago, and this was the poster for it. Insatiable, out of control, nothing can stop it, the blob, Fannie Mae, Freddie Mac. And we showed how the exact same thing happened at the end of the 90s, and it's happening again today.
Well, I was there for the first movie, so the sequel's no better.
The time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Budd.
Thank you, Mr. Chairman. And also, again, thank you to our witnesses, each of you, for being here today, what I think is a very important hearing. I think the time is right for Congress to make a push towards housing finance reform, and if we don't act in a timely manner, the same risks that were at the root of the 2008 financial crisis are going to continue building up in the system. And we all know how that story ends. Taxpayers and my constituents, the people I serve back home in North Carolina, they're on the hook. Taxpayers are on the hook. So, Mr. DeMarco, my line of questions are for you this morning, or afternoon, whatever it is afternoon now. In your testimony, you write that, quote, "The uncertainty about the future of GSEs and about the government's next steps stymie innovation and long-term strategic investment by private lenders and services and other stakeholders in the system," end quote. So this is an important point that will not be solved by continuing the status quo like we have now and thinking that what we have today is just good enough. Markets need the long-term certainty that can only come from real legislative reform. So my question is, what insights do you have today about the advantages of legislative reform over administrative reform in providing certainty in the market?
Just what you said, Congressman. Even if legislative reform has a multi-year transition cycle to it, financial companies, mortgage lenders, servicers, everyone else that participates in this ecosystem can know with some certainty what the role of the government is, what the long-term framework looks like, and can make strategic business decisions and capital investment in housing finance with some certainty about what their role and opportunity is going to look like. As long as we keep this cloud of uncertainty, they don't know whether those long-term investment decisions are going to be sound or not, because the government is creating this uncertainty.
So just to further clarify, so you would agree that it puts taxpayers at risk by avoiding long-term legislative solutions to fixing housing finance reform?
Yes, sir.
Okay. Do you believe that we will ever reach a level of private capital necessary for a functioning mortgage market without legislative action? Without legislative action?
Not without legislative action.
Okay. And finally, what areas in mortgage finance would benefit the most from ending the GSE duopoly and opening up to competition and innovation?
I actually believe that we can do a lot more in the affordable housing space and in the innovation of helping borrowers where their actual needs are. We don't have innovation in that space. It's only what Fannie and Freddie allow through.
Thank you. Mr. Marco, that's the end of my questions. I yield back to the chairman the remaining time. Thank you.
Gentleman yields back. There are no other members in the queue who have requested time, so I'd like to thank the witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I would ask our witnesses to please respond as promptly as you are able. This hearing now stands adjourned.